Paul Ezel, the virtual investor here. And today I want to talk about headwinds we have in the current economy for real estate investors here and the tailwinds that we have. All right, but before I dive into it here, make sure you click on the subscribe button. And if you like this, make sure you hit the like button and hit the bell notifications to get notified when we put out new videos. Okay, first, let's talk about the headwinds and what's going on in the current market. This is being recorded as of late June here. So the data I'm going to give you is based off late June's data here. So interest rates have more than doubled from the beginning of the year. We started in January at 2.75%. We're now 5.83 as of June 24th. So the numbers have increased quite a bit. That's part of our headwinds that we have here. The next big thing we have as real estate investors, what we're facing is inflation. So the cost of materials, the cost of labor, the cost of fuel, everything is going up, right? The cost of everything is going up. That's a headwind both to us as investors if we're doing fix and flips or just renovating for a buy and hold, or for our buyers, our end buyers, right? The more things cost, the less they can afford. So those are big things, right? And gas prices, everything is driven by gas prices, another big headwind. And they're expected and anticipated to be continuing to increase here throughout the year. We'll see what actually happens. Hopefully we do get some relief there, but as of right now, we can't anticipate that. The next headwinds we're facing is recession fears. The Fed keeps saying we don't have any recession and looming here, right? But they say that all the time and they're almost always wrong. When you look at the economic indicators, everything out there, where things are heading, we are heading towards a recession. We've had negative GDP. So if we have that for a couple quarters in a row, we're going to be officially in a recession. My gut tells me we're in one now. We're very close to one right now. And once we start seeing that, once we start seeing employers start laying people off, that's going to have obviously a continued negative effect on our end as real estate investors trying to find more home buyers. The other thing we have, huge headwind here, because the increase in this rate's more than doubling. By the way, in no time in our history of the United States have rates doubled in one calendar year. So we had that in the first quarter of this year. So think about that, first quarter going to the second quarter. We had a huge increase in rates with the Russia-Ukraine war and just with inflation going on here. The other thing we have is 9 million home buyers falling off, right? 9 million home buyers. They're mostly first-time home buyers, but they can no longer afford to because of the increase in rates afford a home that they were able to afford just a few months ago. Huge factor right there. 9 million, fairly substantial amount. On the plus side, if you are on a lower end of selling real estate, people that were on a high end, say 450 and above, now fall into the next tier level, and where you're going to have potential, some of those buyers falling off the bottom, but other buyers bumping down to your level. So that's something important that we're going to talk to here, and what you should do strategically for the rest of 2022 and into 2023. And the other headwind we're facing is inventory starting to increase because of the interest rates, right? Everything's factored in and pushing everything up. Inventory is starting to increase, and it's increased 8% this year. So over last year, right? So not substantial, right? We're still far below where we need to be for a healthy real estate market. It's 6 months of inventory. I think we're still under 3. So we still aren't even halfway there. So something to consider there, that it is growing, and that's just another headwind in our face. Okay, now let's talk about the tailwinds. What we have going for us, what we have going in our favor as real estate investors. First is still historically low inventory. Right, the inventory is still low. That's helping. That's why we haven't seen this dip in pricing yet. Don't know when we're going to see that. I anticipate the third quarter here, going into the third quarter, we'll start to see a decrease in price, or at least plateau, maybe the start of a decrease in the median home sale price. We've already seen a decrease in the listing price, but that's been slight, ever so slight. So my gut tells me we peaked, and we're maybe heading towards a slight downturn is where we're heading. Other tailwinds we have, baby boomers, the largest generation. They are still retiring and moving to the sunbelt. So for those of you who own in the sunbelt or operate there, sunbelt being Florida, Georgia, South Carolina, Alabama, Texas, Tennessee, even parts of Tennessee, right? still red hot, and Arizona, New Mexico, Southern California, and Nevada. You're still getting people moving there. Different reasons, right? For Nevada and Tennessee being zero income tax states than being great weather, right? The weather's okay at those places, but it's not like Arizona, not like Florida, not like Southern California. Those are your primary markets where people want to retire to: Phoenix, Arizona, anywhere in South Florida, really in Florida in general, and even Georgia and South Carolina, and especially Southern California. But Southern California has become too unaffordable for people to retire. So you cannot retire there and pay 20% income tax and pay those crazy prices that you're paying for real estate. So that's going to dry up quicker, right? And your next area that's going to dry up quicker after that, or your next level down, will probably be Las Vegas, because Las Vegas will be hit as soon as the job market's hit. Las Vegas tanks, right? Las Vegas market really drops. So that'll get hit that way as well. Whereas I think Arizona, I think Texas because of jobs, and I think Florida, Georgia, and South Carolina will still have an extra maybe 6 months to a year of growth, or at least being affected less, because those would be desirable areas for people to go. And they're still affordable enough places to live as well. Tennessee is going to get that bump as well. So those are some of the tailwinds they have. And another tailwind, it's both a good and bad, right? As far as rates have been increasing, but historically rates are still low. They're under 6%. And historically in this country, 8% is the average mortgage rate. So you're still below historical numbers. If we get to that 7-8%, I'm going to raise alarm bells, and I'm really going to start changing what I'm doing more and more drastically. So let me tell you a little bit about what I've done to change here, to adjust for the second half of the year. So most real estate investors, when they're looking at properties, they're coming up with their ARV, their after repair value. They'll obviously have their number. Let's just use a number of 100,000. Let's make it simple math. And you're taking 75% of that for your profit minus the repairs. Let's say it needs 25 in repairs. So now you're down to 50,000. That's your maximum allowable offer, your MAO. Now, if you want to wholesale that, you got to drop it down another 10,000, because you want your wholesale fee to be roughly around 10,000. So that's your maximum allowable number. So now what I've done is I'm reducing that number. I'm going down to 70, and in very rural markets, I'll go down to 65%. Just reduce a little further. I'm planning on anticipating about a 10% drop over the next year or so in different markets. Some markets will get hit more, maybe 20%, and some markets hit less, and some would be largely unaffected, because we have so many different markets going on right now, and people leaving for so many different reasons, which is, again, a part of the tailwinds for us here too. Employers are still allowing people to live in other areas and work virtually, right? So you can still move to Florida if you are in New York or New Jersey or Connecticut, and work virtually and live in a place where you desire to be, right? So you still have that happening, and people see interest rates rising. So it will force some people's hands to move down when they want to, even if they're not ready to move. They might force people's hands. That's going to temporarily still boost us for a little period of time here. So keep that in mind as well, where you're investing. Now let's talk about what type of markets you should invest in. As the market shifts, you should look at and go from a cyclical market to linear markets. So if you're like me, a virtual investor who invests all over the country, I'm going to shift my focus from those cyclical markets to more linear markets. Linear markets mean they're more consistent, right? You don't have the big ups and the big downs like you have in Southern California, Arizona, Florida, and Las Vegas. So you're going to focus on markets like in Ohio, Indiana, North and South Carolina, Michigan, Missouri, Kansas, Oklahoma. You're going to focus on more of these markets that are more stable, and even Tennessee, different parts are still linear, like Memphis, Chattanooga, and other areas. So focus more on these types of markets. This will help you reduce your risk, right? And then you don't have to adjust your numbers quite as much. Positive here of a recession for real estate investors, it shakes out the newbies, more the newbies, right? So you have less competition, less people overpaying for real estate, which overall is going to help you get bigger margins, right? So deals will be easier to come by. and competition will be less fierce, and your marketing dollars hopefully will come down. If you're somebody who's doing direct mail or pay-per-click, those numbers should drop. So some positives to a recession. And a lot of us real estate investors have been looking for a recession because we generally do very, very well when the market's down, just because less competition out there. And we're able to get better deals, bigger spreads, all those kind of things. So those are the headwinds and tailwinds. And what my plan is, obviously, I'm just going to reduce the amount I'm offering. I'm going to reduce my maximum allowable offer. I'm going to build in a little bit of cushion, figure 10% cushion, because I still don't anticipate the market's going more than 10 or 20%, depending on where you are, just because we don't have, this isn't 2008, right? Where you had things correct 30% in different markets, and other markets only corrected 10 or 15%, like Dallas, Texas, and like the linear states in the Midwest. So keep that in mind, right? Focus on just reducing 10% of your price. And hopefully these deals will start coming more often, bigger spreads, and you'll be doing better, and you'll still be in business, because the key is staying in business. It's longevity. I started this business 2001, 2008, really. That financial crisis really hit me hard, but I just shifted and adjusted and went into the next uptick here that we've had in real estate since, really, frankly, since 2013. This is a 9-year period, nothing but going up. So we were due for a downturn here, and we'll see where things go. But just be smart, be diligent, reduce your numbers, and good luck out there, guys. Catch you next video.